Hey guys, this is Matt with the Bullish Bears Group. I just want to take a few minutes here to talk about the differences between selling spreads and selling naked positions. So if you're fairly new to options, a naked position is when you sell one contract, and if you sell a spread, you actually sell a contract and you buy another contract. So it's a combination of two, but you sell it together as one trade as a whole, and we call that a spread. If you're unfamiliar with some of the terms that I'm using, you might want to go back to some of our previous videos and catch up on the inner workings of how options are priced. So the first and probably the most obvious difference between the two is the difference in the capital that it takes to hold that position. So obviously a naked position is going to require far more capital to hold that position than a spread would. So if we go into our Thinkorswim platform here, we're going to kind of look at the little past history of Apple. We said we had a huge spike in implied volatility here, got close to being oversold. So for the purpose of this video, let's just say that we believe that Apple found solid support here, and we believe it's going to trade sideways or possibly even up. And we want to come way down below the market and find our 70% probability of profit trade, and we want to sell a naked position or a spread way down here below the market. So if we go to the options chain, we come over here, we find our probability in the money. We go down, we find that 70% probability of profit trade. And in this case, it's going to be the 210 mark. So if you right click, click sell, and click single, you'll see that it pulls up a single contract. So what you would actually be doing here is you would be selling the 210 strike for $360. So you would actually be taking in a premium of $360. That is the most that you can make. However, if you confirm and send that, take a look at what your max loss could be. $20,640. That is a huge number. Not to mention, if you come down and look at the buying power effect, it would actually cost you $3,159 just to even hold this position. So unless you've got a very large trading account, trading naked positions is going to be very difficult. However, one way we can get around that is if you right click, go to sell, and click vertical, you'll see here it pulls up two contracts. So what you're actually doing is you're selling the 210, but then you go out and you buy the 205 for protection. And the reason that we do that is because if Apple were to just completely fall through the 210 strike and go all the way through the 205 strike, your 205 put is making money as you're losing money on the 210. You're still going to lose money, but the 205 makes it what we call a defined risk strategy. So if you confirm and send this, the first thing I believe that you're going to notice is that $20,000 is now down to $403. And your buying power effect, which is what it's going to cost you to hold this position, has been decreased down to $403. So $403 is the most that you can lose on this trade, and the max that you can make on this trade is the $97 worth of premium that you take in. So that is going to be the big defining difference between whether or not you can sell a naked position or whether you need to sell a spread position. It's going to come down to what size account that you have. So 2 and 3 kind of go hand in hand. Obviously, a naked position is going to require far more capital. It's got higher risk, and in any market that you trade, the higher the risk, the higher returns that you're going to have. Whereas a spread, you have a defined risk. It lowers your risk. So therefore, you're going to have a lower potential of profit. Again, if we go in the option chain, we go back to our 210. We go to sell the naked position. Let me go back and sell a single naked position. You see that we can make $360 on this trade. However, if you do the spread, you'll see that the max that you can make is $97 on this trade. So you're giving up a lot of leeway. But guys, is it really worth that? If you have a small account, and this is the only trade that you have on the table, is it really worth trying to trade that naked position? Even if TD Ameritrade or your broker will even let you hold that position, I'd say the chances are unlikely that they're going to let you hold such a large position with a smaller account. So that's a huge benefit with the spreads, is it lowers your capital required. It defines what your risk is. It actually lowers your risk. However, it does kind of lower your potential of profit. Now let's talk about our break-even points. So if we go back to Apple, we'll go back to our options chain. Let's go back in here. We want to sell our naked put again. If we go up here and look at our break-even stop, you'll see that your break-even point is actually 206.40. So guys, what that is that is your strike minus the premium that you're taking in. And that's where they get the 206.40. So long as Apple stays above 206.40, you're making money on that trade. But if it drops below that, you're going to be losing money. Now, keeping that 206 number in mind, if we go in here and we actually sell a spread on this, confirm and send it, you'll see that you give up about $3 on your break even. So here, so long as Apple stays above 209, you're going to be making money as opposed to the 206. So you don't have as much wiggle room for Apple to actually go against you before you really start losing money. However, again, keep in mind that you're minimizing your risk, you're defining your risk, and you're lowering your capital to hold that position. And let's talk about theta for a second. We know that if you're going to sell options, you want to get in when IV is high, when implied volatility is high. You want to take advantage of that drop in implied volatility so you can bring those option prices down and buy them back at a cheaper price. So the longer that you hold this position, time decay is going to be in your favor. However, with holding a naked position, time decay is going to wear on that option that you have sold a lot quicker than it will a spread. Because with a spread, basically, when you sell one and then you go out and you buy one, you're basically rendering time decay. I'm not going to say irrelevant, but it is far less of a factor if you do it that way. So all in all, which one is better? In my opinion, and for my account size, I would definitely have to say the spread. It wins hands down almost every single time. It minimizes your risk. It gives you a defined risk. It lowers the capital required to hold that position. Hands down to me, I believe the spread is the best option every single time. So guys, we're going to do a few more videos. If a lot of the terms that I'm using, if they're not making sense to you, go back and watch the previous videos that we have breaking down the inner workings of options and learn those first before you start trying to take on spreads and especially selling options. And until the next video, thank you guys very much for listening.